Welcome to The Explainer. Today, we're kicking off a new series, diving into a white paper that makes a really bold claim. The era of calm, predictable markets? Yeah, that's over. They argue that the next 10 years are going to be defined by chaos. They're calling it the Volatility Decade. And today, we're going to tackle their opening argument. So to understand why the authors are so certain about this, they don't just start with a forecast or a bunch of charts. Nope. They start with a story, a true story from September 2022 about how one of the world's biggest economies came within a whisker of total collapse in just 5 days. So on September 23rd, the UK's brand new government announced this huge package of tax cuts. We're talking the biggest in 50 years. On paper, it's an ambitious economic plan. But the market's reaction wasn't just negative, it was immediate, and it was absolutely violent. What happened next was just this brutal, self-reinforcing spiral. Gilt yields, that's the interest rate on UK government bonds, they just skyrocketed. This triggered massive margin calls for pension funds, basically demanding they pony up more cash right now. To get that cash, they had no choice but to sell their gilts. But all that selling pushed prices down even further, which, you guessed it, triggered even more margin calls. It was a complete doom loop. Within days, the Bank of England had to slam on the emergency brakes to prevent a total meltdown. Okay, but here's the thing. Governments announce tax cuts, they make fiscal gambles. That's not new. But the sheer violence of this reaction was completely off the charts. And that begs the really crucial question. What had changed in the system to make it so unbelievably fragile? Let's think about it this way. If this exact same policy had been announced back in, say, 2010, it would have been a minor news story. A stern editorial in a newspaper, maybe a small bump in borrowing costs. But in 2022, that same little spark nearly burned the entire house down. The policy wasn't the variable here. The whole financial environment was. So what changed in that environment? Well, the paper argues that it's the failure of these invisible safety nets that markets have been relying on for decades. The very structures that were supposed to absorb shocks just like this one. The paper gives these safety nets a name: containment frames. You can think of them as the institutional, monetary, and political shock absorbers that have kept the global financial system more or less stable for the last 30 years. So what exactly were these frames? Well, first, you had central banks whose credibility was basically rock solid. Second, governments that had what's called fiscal space, enough financial firepower to step in during a crisis. Third, that reliable old assumption that stocks and bonds balance each other out. And finally, you had deep, liquid markets that could soak up huge trades without even breaking a sweat. For 3 decades, these frames held the whole thing together. But here's the crucial point. These frames have become brittle. They've been weakening for years. That UK policy didn't cause the crisis, not at all. It was just the shock that revealed the entire global system was already incredibly fragile, just waiting for a push. And all of this, the UK crisis, these brittle safety nets, it all leads to the paper's central and, let's be honest, pretty alarming thesis. The authors argue that the global financial system hasn't just hit a rough patch. It's entered a totally new structural regime. Not a temporary blip, but a persistent, long-term state of high volatility that's going to last for the next 10 years, a period they've dubbed the Volatility Decade. And they are incredibly confident about this. Get this. The authors assign a confidence rating of 0.85 to their thesis. In the world of forecasting, that is practically a certainty. This isn't just a guess for them. They believe it's a diagnosis of reality. Okay, so what's the evidence for such a dramatic diagnosis? The paper points to 4 deep, fundamental cracks that are forming in the foundation of the old financial system we all grew up with. First up, policy exhaustion. Basically, governments are so deep in debt, they just don't have the ammo left to fight the next big crisis. Second, credibility erosion. After calling inflation transitory and then being spectacularly wrong, central banks have lost some of that market calming magic. Third, correlation breakdown. The old golden rule that bonds protect you and stocks fall, it's broken. Now they often fall together in a crisis. And finally, liquidity brittleness. This means even the biggest, safest markets in the world, like US Treasuries, are getting fragile and can suddenly seize out. So, if the entire game has changed, if the rules are different, what does that mean for how you invest? The paper's conclusion is stark. The old playbook that worked for decades is now completely, totally obsolete. And this table just shows how total the shift really is. I mean, look at the stock-bond correlation. It went from being a negative diversifier to being positive in a crisis. Or look at volatility itself. It used to be episodic, a fire that was quickly put out. Now they say it's structural and persistent. The old strategy of just buying and holding no longer cuts it. The paper argues this new world demands a much more active approach. This means that portfolios built for that old world, like the classic 60-40 stock-bond mix, are just structurally out of sync with our new reality. And those painful losses that so many people felt in 2022, well, that wasn't a one-off black swan event. It was a preview. It was a trailer for this new regime. And so the paper leaves us with this final, really provocative thought. The canary in the coal mine has stopped singing. This isn't a prediction of some future crisis. It's a diagnosis of the fragile reality we are in right now. So the real question isn't if the world has changed. It's now that you've noticed, what are you going to do about it?